This is a demonstration of how three-way driver-based forecasting works in an architectural firm, enabling firm owners and other stakeholders to see where you are now, where you've come from and where you're heading, so you can design a better future for your firm. Combining the profit and loss report, cash flow statement and balance sheet is typically referred to as a three-way financial forecast. The real power of the financial forecasting process comes from the strategic thinking that's involved. Three-way forecasts have accounting integrity that can withstand the scrutiny of banks and other stakeholders. It also allows you to identify issues and opportunities ahead of time, giving time to formulate plans, allowing you to make assumptions and run what-if scenarios, and laying out a path to follow and compare your actual results against into the future, as well as giving external stakeholders comfort. Assumptions are typically based on your business's key operational drivers. They should be defensible and transparent, allowing them to be stress tested to see if they're reasonable. And it allows you to answer the following sort of questions, all things remaining equal. Things like, what happens if the multiplier goes from 2.8 back to 2.7? What's the drop in revenue? What's the drop in net profit after tax? What happens if our utilisation goes up? Or what happens if it goes down? What happens if we add a senior professional to our team in September? What's the new revenue target if we want to maintain our multiplier? And so on and so on. Now, the demonstration itself is going to be about a fictitious firm called Archidemo Pty Limited. The owner of this business has come to me, and he thinks that in order to achieve sustainable growth into the future, they need a more structured and strategic way of managing the business. The first thing to do is to have a look at the opening balance, or the last financial accounts that we've got. And in this case, they're to June 30, 2024. I've done a little summary of that. You can see just off to the side, its turnover is about 4.5 million at 2.48 multiplier, utilisation 69. There's 18 people. They've made a net profit of about 16.9%. And the firm's running quite well. Now, a bit of background to building the model. I like to describe the cost structure as having these broad categories or buckets that you need to put all the costs into. Now, the biggest of those for an architectural firm is staff costs or labour costs. And you can split this up into two categories, productive and non-productive, by using the job costing or timesheet information. You then run this through the profit multiplier and it becomes revenue. So the profit multiplier is the effective rate that you convert productive direct labour into earned value. And the multiplier needs to cover the direct labour, but it also needs to cover the other costs as well and make a target profit. So it needs to cover the fixed and variable overheads. And the variable ones are more dependent on headcount, whereas the fixed ones are more to do with contracted obligations regardless of activity. The interest and depreciation buckets, these feed off the balance sheet. They're not really tied to headcount. They're more to do with capex and what's called gearing, which relates to borrowed capital. So the first place to start is the salaries bucket. What we want to do is map out our staff numbers in a full-time equivalent or FTE basis and spread it across the position bands using average salaries. Then when you run that through the utilisation, you can split it into productive and non-productive, and that helps us then to create the targets we're trying to hit. And probably just a point to note, I'll just run my cursor over it. These utilisation numbers, be aware that it's possible to get a different effective utilisation compared to a straight average. So the effective one is using a weighted average. And it's important to understand the difference. You could have a straight average of 70%, but the effective one is only 65%. If you don't understand this, you'll never look at utilisation as a problem, when in fact it might be. Now we look at the overhead buckets. It comes from analysing your costs from prior periods and also your expected costs. It's much more like budgeting. It's stuff that we typically spend money on, both discretionary and non-discretionary. It's going to contain all of the detail, the things, the pens and pencils, the staff, amenities, the rent, the power bills, all that sort of stuff gets entered into this broad sort of budget detail file. And then we can group them into broader categories within the fixed and variable buckets at an appropriate level of detail. We're not going to carry it away. We're not trying to split pubic hairs here or anything. And we can convert this raw data into a pivot table. Of the pivot table, we've got this total 1.4 million. You'll see that again as we move into the rest of this demonstration. And we can apply a percentage against each of these components of each bucket. If you can wrap your head around the concept that if this bucket cost this amount of money for 20 staff, and that number grew to 40 staff, we'd expect the number in the bucket to double as well. That's really what we're doing. We're using the baseline full-time equivalent staff number to pro-rata the variable cost bucket. So if that staff number changes, we'd expect to see a change in the variable cost. All of this comes together. We see it here in our projected 12-month, effectively the budget for next year is what we've got here forecast. Come down, you can see the 1.4 million. So we've mapped that out by month. Our staff costs, we'll go back to that bucket again. See the 2.815 million. You'll see that over here as well. 2.815. And at a multiplier of 2.8, they're getting this 5 million. So, and then 551 net profit, right? The next thing I wanted to take you over to Castaway. Castaway is a best-in-class business modeling software. It creates a living, breathing model of your business that can be easily adjusted as business conditions change. It consolidates and connects the actual budget and forecast data through a layer type approach like Photoshop. And it spits out bulletproof three-way forecast models that banks love and don't contain Excel formula errors. So let's just dive in. See here, come over to the totals for the year. There's our 5 million again. There's our 2.815. Here's our 1.4 overheads, and here's our 551 net profit after tax, just here. So what we're looking at in Castaway here is, well, the output that we looked at before came from Castaway. So here we are. We're now in the living, breathing model. We can come down all of these things that we worked out before. So staff numbers. You'll see there we've mapped it out per the matrix. We've got it's rounded it up to 20, but it's really 19.5. We've used 19.5 as our baseline as well. And then we've put in our average salaries. Then we've put in our utilizations. And we've shaped those utilizations according to our belief that Christmas time's a seasonal dip. We've then got our variable overheads. You can see they're 40 grand a month. That's what we worked out through the raw data and pivot table process. And the same here for the fixed costs. And what's happening is all of these drivers, and we can go to there's actually a driver report, right? So this can be printed out. And all of these things are easy to tick off. These people's salaries, easy to tick off. Tick, tick, tick. Some of them are formulas that you won't want to tick off, but it gives you a lot of comfort about the assumptions. They're all mapped out on this page. And we can also, if we go into sales, and you can see here that it's been driven by a formula. It's not entered. And that formula is basically saying, give me the productive direct wages, times it by the multiplier, and we've got this divide by 1,000 in here to give us a couple of extra decimal points. Once you have this base model, then you can start doing the what-if scenarios. And at the start of this demonstration, we said, well, what happens if the multiplier goes from 2.8 to 2.7? We're going to go in and change it. And come down to the multiplier. And we're at 2.8. Let's change it to 2.7. So at the moment, we're at 5 million in turnover and 551. Change it to 2.7. and we'll fill that to the right. And then we can quickly come in and have a look and say, okay, by dropping the multiplier from 2.8 back down to 2.7, our turnover has dropped down from 5.016 to 4837. So we've lost 179,000 off the top line. Now you'll see the salaries are the same. You'll see the overheads are the same. Nothing else has changed other than our effective rate of converting direct labour to earned value. And that's had a bottom line impact down there as well. So it's cost us 179 off the revenue number, and it's cost us 134 grand net profit. That's the effect of that drop in multiplier from 2.8 to 2.7. Okay, so what happens if the utilisation goes up or down? So the easiest way to demonstrate this, if we come back to the forecast and we have a look at utilisation, and let's say, for example, we'll come into the principal. We've got them at 60%. Let's just change it. And we'll do it just in this month because then it'll contrast against July and October next to it. So at the moment, they should be the same. Let's see, September and October the same, 418. Let's just go and change the utilisation for the principal there. We'll turn that to 100%. What's that do? So we can see there straight away we've gone from 418 to 457 by increasing the utilisation just of one band of people. So it's changed the split here. It didn't change the total, but it changed the split because the utilisation, the productive and non-productive has changed. And we've kept the multiplier the same. So you can see there that you can have a look what's it do if the utilisation changes. Obviously the same thing you can put in. What happens if salaries change? What happens if headcount changes? And then you've got what happens if we, decide to take on, some more software or something like that. We can change those settings. And what happens if we put on a new staff member? So again, we'll come into the thing, the forecast, into the drivers. We'll have a look at headcount. We've got 19.5 at the moment. What about if we put on another 2 principal, or just 1 principal? Let's say that from September. We'll change that from 2 to 3, and we'll run that through to the end of the. Now we had 5.016, and now we're at 5. So that one extra principal that's been added in is going to need to, at that multiplier, make 293,000 in extra revenue. So they're all very interesting calculations that you can do when you run these what-if scenarios in your business. The first step is getting control of the base case, and from there you can start doing some really good scenario planning. And these models actually go all the way out to 5 years. At the moment I've got a 3-year one here for the demonstration, but you can go out to 5 years. And it just means coming out into these out years, and you can adjust them by CPI. If you, not for staff numbers, but for salaries, you might adjust that by CPI or something. Some of these other costs you can adjust by CPI. So you're going to get your figures pretty close, making those assumptions about CPI and stuff. Now, I think where this becomes really interesting. So we've now loaded up our opening balance from the June 30, 24 trial balance that Archidemo gave us. You see that over here in the prior period. We can close that away if we want to. I'll leave it there for now just because we're happy with these numbers. We've put in our forecast for the full year, giving us the 5.016, and this is called the original budget, right? Now, let's imagine that the July month end has just rolled around and we've been given a trial balance by Archidemo. So we can just pick a trial balance out of our accounting software. In this case, it was 0. And we put that into this upload template and we upload it into our model in Castaway. And when we do that, you can see here in the openings and actuals, all of these numbers that we've fed in. As far as the variance reporting for the actual month then, we can see here that we had 410 versus 418. So we're a little bit behind on the revenue. We're behind on staff costs. So maybe we didn't have an extra person that we thought we'd have to earn that revenue, but we've actually earned it at a better rate because you can see here the bottom line slightly improved as well. So what that gives us, if we look at our forecast now, these are the elements we've got coming in. We've got our opening balance, our historicals. We've got our actual month result for July, and we're adding that in against the rest of year budget. And you can see there that the full year forecast number 5.009 is different. This one was 5.016. So we've had to adjust the full year forecast because we didn't quite do what we thought we were going to do in July. Now, obviously, we can play around with these forecast settings as much as we like. And at the end of each quarter, so at the end of the first quarter, we've used our budget numbers as our target. Whatever we've got locked and loaded from September onwards, we need to lock that away for the Q2. So that'll give us October, November, December. As at the end of September, give us a realistic target for the next quarter. And so on. In December, we'll set up the next quarter in January, February, March. End of March, we set up the last quarter, Q4, April through to June. So it's a continual process of updating the drivers, updating the forecast, feeding in the actuals, and comparing that. Incredibly powerful software and putting you in complete control of your business. If you've enjoyed watching this and you'd like to find out more, you can jump on our website, www.custodianbackoffice.com. And there's plenty more resources there that talk about how we can put you in control of your business. So, if you believe that a more structured and strategic approach to managing your business can improve your bottom line results and you'd like to talk to me, reach out on the Contact Us page. I'm David Dillon from Custodian Back Office. Thanks very much for watching.